Hello there, dear friends. If you can see and hear me, please drop a plus symbol in the chat. Great, everything seems to be working just fine. As you may have noticed, we've slightly adjusted our format. Every Wednesday, we alternate between doing a market overview, where we pick specific assets, and answering your questions. Today, we're focusing entirely on your questions. Here's question 1. How do you pass prop challenges with a low win rate but a high risk-reward ratio? This is an excellent, very insightful question. There are essentially two ways to pass a prop challenge. It's when you've got a very high win rate and when you have a low win rate but a high risk-reward ratio. That happens too, and it is perfectly fine. It's not great, but not too bad either. It's perfectly normal. I have a student named Andre who has a win rate of only 19%, but his minimum risk-reward ratio is 7-to-1, and his results are phenomenal. It's completely normal, and it depends entirely on your trading style. So what should you do if you have a low win rate but a high risk-reward ratio? You must trade with low risk. This is super important. Essentially, when your win rate is very high, you can afford higher risk per trade. That said, when your win rate is low, you must work with lower risk. Simple as that. Why is this the case? Now, for example, if you set a risk per trade of $100 and achieve a win rate of 6-to-1 or 7-to-1, you earn $600. In this scenario, it's critical to trade based on risk for one simple reason. When you begin trading, you have absolute risk thresholds you cannot go beyond. Your entire strategy must be built upward from this risk baseline. Imagine your daily risk limit is $500. This means that if you have a very low win rate, for example, below 30%, and you make 5 trades a day at $100 each, you would exhaust your daily risk limit and obviously lose the chance of passing the challenge. However, if you set your daily risk at $50, you can technically afford to work with a low win rate. But another problem emerges here. For instance, if you are trading futures, a $50 risk threshold is unfortunately insufficient to make any trades. In other words, you physically won't be able to trade gold, silver, or oil with such a low risk threshold. So, there is only one way to go about this. Just opt for a larger prop challenge. This allows for a higher daily risk threshold, and you can trade with a lower win rate while maintaining a higher risk-reward ratio. When a major player kicks out extra passengers preparing to go long, they flush out other long traders by means of false breakouts. How could these traders possibly interfere, and why are they being forced out? Most likely, the major player has not accumulated a sufficient position just yet. A position can only be accumulated against opposing players. Otherwise, no one will give them their position. For instance, when an asset demonstrates a strong upward move and someone wishes to accumulate a short position, they won't simply stand against the market, as they would be crushed, much like what happened with car stock. This is why they orchestrate these false breakouts. There's also a second common issue. For example, as an asset moves up, retail traders or private retail investors start placing a bunch of limit orders against the move to make it exit from that area. What does it do? To continue the upward trend, it would have to chew through all those limit orders placed by people who went long at the very bottom and are now placing limit orders. So it is much easier to shake these players out of the market and move upward or downward without the added competition. When can or should you trade a breakout at the market open? I often see the price soar in the direction I anticipated. Is it okay to enter during such high volatility, or is it better to wait for it to die down? No, you can enter at the market open under a few specific conditions. First, the asset must have closed as close to the level as possible. Second, there should be void above or below, meaning there is significant room for the price to move. Third, there must have been a very strong period of accumulation. Fourth, the asset should have tested that specific level previously, pulled back, and then returned to it. These 4 rules are what you should look for when considering a breakout trade. Don't be afraid of breakouts at the open, especially if the asset is showing relative strength or weakness compared to the market. If we have our stop-loss order when trading a false breakout, should the buffer, aka luft, be calculated based on the original stop-loss order or the tightened one? Naturally, the buffer is always based on the actual stop-loss order you are using. In this case, the shortened one. However, if you see high volatility near the level, you can afford to give it a slightly wider buffer. The buffer itself is so small that a minor increase in size near the level won't negatively impact your trade. Does it make sense to devote a massive amount of time to trading by staring at charts and analyzing historical data, or does it have a destructive effect on our psyche? This is an excellent question. I truly appreciate insightful questions, and you will get an insightful answer. So-called trading vision is easily the best thing that can happen to you. There will be no destructive effect, especially if you pinpoint a specific pattern. That is the first thing. Second of all, what did I do in the past? How did I learn to trade? I would cover the right side of the chart where the current price is, hiding any significant movements that had occurred, and then try to figure out if any prerequisites in that asset led to, for example, a rise or a drop. So, yeah, that's a very good question. We have great questions today. The answer is pretty simple. Absolutely. You can look at charts and try to find certain patterns. The more you see them, the more refined your trading vision will become. In crypto, I often see that if a coin has a free area or a void, it often fails to move lower upon entering that area. And more often than not, the price goes up and down around the level. What does this mean? It means the asset isn't ready to go short just yet. You must wait for an upward pullback and then trade the asset in the direction of the primary move. What is the direction of the primary move? For example, if you have a level and the asset tested it but failed to break it out or broke it out only slightly, then pulls back and returns to it. That return to the primary direction means the asset is now ready to move. Sometimes it isn't ready on the first attempt because stop loss orders didn't trigger, were inactive, or there wasn't enough momentum for further move. There's one crucial factor you need to keep in mind. You must factor in how far the asset traveled before reaching the level. If it has already covered a large distance, there likely won't be a breakout on the first try. Similarly, if it moved too fast, there probably won't be a breakout immediately either. All these factors must be considered. Chief, can you briefly describe how an asset should look across all time frames for you to say it's ready to move? That's a good question, but not entirely the right approach. I always look at the daily chart first. On lower time frames, I need to see the asset confirming the move. For instance, if an asset closes near its daily high, it will naturally also close near the high on the 5-minute chart at the end of the day. These nuances must be factored in. The most important thing is that there is no divergence. For example, if the price moved up and down around the level multiple times, or has already made its primary move. To answer your question, the daily chart is primary and the 5-minute chart simply shows the speed of the move. The daily chart is more than enough for me to make a decision. Let me show you an example. Here's a stock car, which I mentioned last Wednesday. I gave you this figure, 415.26. You can rewatch the video. I provided that figure and said that if it's broken out, the asset price will move up sharply, fueled by the massive number of short positions in this stock. Let's take a closer look at this example. What do we have here? This is an all-time high. See how the stock is closing almost at its high. This is already a very strong signal for a continued move. Check out what happens next. There is your target, 500. The 500 level represents the continuation of the move. It's the strongest level. This is the result you got. As you can see, the daily chart provides the entry point perfectly. If you wish to learn how to do this as I did, I always kept a close eye on the asset and its behavior after a very strong accumulation. You must always watch an asset after significant accumulation. Then I always look at the close. See this? Look at the close near the very high. The high is 123.62 and the close is 123.56, virtually identical. Now let's switch to the 5-minute chart. This is before the market open. Look at how we are closing. We are closing almost at the very high on the 5-minute time frame. Next up, we have this prerequisite. The asset moves in one direction all day without a pullback. Look, there was a breakout and the price soared. This is what you must pay close attention to. These patterns and prerequisites are more than enough to open a trade in the direction of a false breakout. Hello, Mr. Gerchik. Can you explain how the price closing behind the level works in practical terms? Let me show you. Let's give our good old Microsoft Paint a whirl, shall we? Here is our level. For starters, you have to understand that there are two scenarios. The first one is a breakout without the price closing behind the level. What qualifies for this? This is a price approaching slowly with no sharp moves. The candlestick's bodies and tails remain small. This is a very strong accumulation. There's a void up there, meaning there are no solid trading opportunities there. And these are pullbacks followed by an approach in the direction of the primary move. The most important thing is that the level is clean, so to speak. This is a so-called primary breakout. You don't need to wait for consolidation here. The second scenario is when the price is moving up and down around the level, or there is an area of uncertainty to the left on the chart. In that case, when the asset enters this area, it likely won't go through on the first attempt. It needs to consolidate for a few bars on lower time frames without price moving up and down around the level to give you the full picture that the instrument consolidated and moved further. There are situations where you must wait for consolidation, mainly where the level is being chopped, or where the price is moving up and down around a level, or there was a previous area of uncertainty. Hello, Mr. Gerchik. Could you tell us how to trade cheap stocks? Look, cheap stocks are traded just like any other stocks. Let's talk about the pros and cons. Cheap stocks have one massive advantage, and this is a low entry cost. You don't need a lot of money to trade them. Second of all, they typically have very low volatility. Third of all, they allow for small stop-loss orders and, consequently, low risk. Small, cheap stocks are traded according to the exact same rules as expensive ones, exactly the same. Don't think that cheap stocks are somehow traded differently. You should trade them exactly as you would trade expensive stocks. The levels are exactly the same. The only big advantage of inexpensive stocks is that you can use limit levels from lower time frames. If you see on a 5-minute chart that these stocks hold levels very well, it's because there are completely different players over there. There aren't as many market makers as there are in Microsoft Corporation stocks or other major stocks. So basically, you can utilize cheap stocks and their levels in the same manner.